Continuing with the Resource Investors Forum in Newfoundland, Canada, we're going to speak with Adrian Day, founder of Adrian Day Asset Management. Adrian, thank you for joining me today.
Well, thank you.
So Adrian, you spoke about the commodity supercycle and whether or not it remains intact. You believe it does. Can you elaborate for us?
Yeah, absolutely. I mean, there's several reasons why commodity prices have been lower this year, whether it's gold or the base metals. And essentially, I look at all of those factors and see that all of them are either exaggerated or that they're topping out or turning around. So, for example, one of the reasons that the commodities are down this year is because of concern about the Federal Reserve tapering, cutting back on its bond buying. But, I think the market's reaction to that has been grossly exaggerated. You think that the worst anyone is talking about is the Fed cutting back from $85 billion a month to $65 billion a month. If they keep on buying $65 billion a month of bonds, that is still an enormous amount of new money creation. And that's the worst anyone's talking about. We've also had concern, obviously, about China's economy. Well, the recent set of economic reports from China, including the manufacturing numbers, seem to suggest, and the import numbers, seem to suggest that the economy is stabilized at a rate of growth of around 7.25%. That is very, very healthy growth, albeit less than we had 2 or 3 years ago. So, I'm very sanguine on it, and I think the reasons that commodities declined are now turning around.
So moving on to gold and gold mining focus, with the current gold prices now, we look back at the nosedive in gold prices in April. What, as an investor, where do you look for value in gold mining companies?
Good question. I tend to look, it's a very, very risky business, as we know. The business is extremely difficult. Whether you're a major mining company, having to face all of the natural challenges, including, water tables breaking and veins running out as you get underground, etc., or whether you're talking about man-made obstacles like governments wanting more tax or environmental and social obstacles. It's just a very, very difficult business. And at the other end of the extreme, for the exploration companies, we all know that the odds of finding this economic discovery, whether it's 1,200 or 1,900, almost doesn't matter. The odds of finding an economic discovery are very, very low. So what I do is I try to look at how can we be exposed to this sector but reduce the risk. So if you're looking at the sort of big sector, I much prefer the royalty companies, which a royalty company has a much lower risk business model than an operating mining company. And that's a way of reducing the risk. And if you're looking at the exploration companies, I like the prospect generator model where companies generate prospects and bring in partners to spend the money. So again, you're using someone else's money. That's a lower risk business model.
Now, with these prices where they are and juniors struggling, the M&A front has been brought to the forefront. And basically what we're trying to figure out is these distressed juniors with deposits that they most likely can't handle. Do you see anything happening on the M&A front where miners that do have cash flow, are cash flow positive, can take these deposits and bring them towards production?
Yeah, no, absolutely. And what you said at the end there is a very key point. I think the M&A we're likely to see in the foreseeable future is not so much a big company buying another big company or mid-sized company, because the big operating companies have all scaled back on their own exploration, on their own budgets. It doesn't make sense to sort of scale down and then go out and buy some. I think the M&A we're going to likely see in the next 6-12 months are small cashed up companies buying companies with good projects but have simply run out of money and can't survive any longer. And we're seeing some of that already, and it may not be complete takeovers, but we're seeing companies with cash taking large positions in smaller companies or smaller projects, but simply they wouldn't have been able to do a year or two ago. And they can do it because the target company has just run out of money. Access to capital is the key right now.
All right, and to wrap it up, obviously everyone's looking for the bottom for miners right now, gold prices, investors, analysts, you name it. Do you think that we've seen the bottom in gold?
I definitely think that the price of gold has bottomed. And the rally we saw from the end of June was a pretty strong rally, We're just now seeing a little bit of a correction from their rally, nothing unexpected. So I definitely think we've bottomed. I think, however, before the sector, particularly the junior sector, before the sector really moves dramatically, you need a higher gold price on a sustained basis, but you probably also need one or two good discoveries, one or two acquisitions, but make people think it's worth getting back into this sector. So I think the opportunity for investors right now is just not unprecedented, but it's a once-in-a-decade opportunity, frankly, because the prices are still very, very, very low, but there are still a lot of good projects out there.
Well, excellent insights, Adrian. Thank you very much for joining me today.
Thank you very much.
And thank you for watching. If you have any comments or questions, please don't hesitate to send them to newsfeedback@kitco.com, or you can hit me up on Twitter @Alex_Létourneau. Have a good one.